Hanna, thank you so much for joining us here at Risk Minds International. It's great to have you here.
Thank you for having me.
What would you say were the key things that this global pandemic brought to the fore in terms of the banking sector's resilience, shall we say?
Yeah, I suppose the banking sector entered the pandemic with significantly stronger capital and liquidity buffers than it did in 2008-2009, the global financial crisis. And I suppose this allowed it to have an ability to absorb unexpected losses without having a long-lasting impact on solvency or capital adequacy. However, when you look at the impact that the pandemic had on the sector, it had varying degrees of impact across banks. And I suppose the magnitude of impact was directly linked to the level of resilience invested in each one of the institutions. So broadly speaking, banks who invested in resilience capabilities enjoyed multiple advantages and had better outcomes than other banks. And those advantages, we can maybe summarize them in four. Number one is the anticipation advantage. You had built this capability to forecast and predict and anticipate threats and issues and risk and take actions early on before the risks materializes and are actually experience losses. The second advantage is the ability to absorb the shock, the impact advantage. And there is the ability to determine the optimal level of financial resources that you have to hold on the balance sheet, be it capital or liquidity, to take on unexpected losses without having a long-lasting impact on performance in terms of value creation and profitability. Thirdly is the recovery speed advantage. So if you had built resilience capabilities in terms of, for example, recovery and resolution plans, and to be able to invoke those plans at very early and quick stage, to be able to have a timely restoration of your financial resources such as capital or liquidity or business continuity plans that we all had to go through the pandemic, to restore services and allow the business to continue to operate remotely and so on. That gives a huge added edge or advantage to an organization. And then finally is the recovery and adaptability aspect of the organization. In terms of post-shock environment, we all have to adapt to a new normal. And what are the resilience capabilities we have built to allow us to continue to thrive in the new environment? Now, if you ask me, broadly speaking, as a sector, we have invested heavily over the last 10, 12 years since the global financial crisis in strengthening the financial and operational resilience aspect of institutions, and rightly so, because we had to build and beef up our buffers in terms of capital and liquidity and so on. I suppose moving forward, the scope and the focus is going to shift slightly towards the strategic resilience of the institutions in terms of trying to allow them to steer in an environment where you have so many unexpected risks and losses and uncertainties and navigate through this to always recover in a faster way and adapt to the new environment.
Tell me more about that strategic approach. Which banks are doing it well and why is that and what are you seeing the best players doing well at this point?
I suppose on that last point, the strategic steering advantage is allowing you to design processes and structures that are flexible and agile. As a banking organization in general, we tend probably, especially those of us who have been in the business for a long time, we might have maybe legacy systems out there that are very, very rigid. We can't, embark immediately on a digital transformation agenda quickly enough to cope with the customer demand or expectations in terms of digital. I suppose once you have built structures and processes that are agile, that are flexible, that allow you to have quick decision making, even from a governance perspective, you're allowed to move faster to deal with I suppose the customer experience in a much better way, a more efficient way. That's strategically an edge to an organization than the ones that, let's say you go to a bank, you apply for a loan, it takes you 5, 6, 7 weeks to get an answer. Nowadays you have new banks, and call them neobanks, coming into the market where you just download the app and in a few hours you have an answer. That's one aspect of it. The other aspect is, I suppose, is this strategic review of are we fit for the future as an organization? And we look at all the trends and the developments, be it digital, be it with climate change agenda out there. And when you look forward from an horizon scanning perspective, there's all sorts of certain patterns and trends happening. You look at them at yourself from a business model perspective. Is that model fit for that future? And if not, what are the changes we're going to do today to make sure we're fit for that environment? Because
after all, those risks aren't just financial ones, are they? There's that piece around expecting the unexpected. I mean, how do banks go about doing that?
That's absolutely correct. Historically, as risk manager, we would have tended to focus, and this is how we built risk functions in the past, around risks that we know. So we call them the known. So credit risk, we know that because we are in the business of lending. So the default aspect of the loan is is quite known to us. There's the market risk, operational, and so on. The unexpected is an emerging. Let's be very honest about it. It's an emerging industry. I call it emerging risk management, where it's dealing with the known unknown to start with. So those are the risks that you know they are out there. They're on your radar. They're on risk radar. But you cannot quantify them yet, or you still don't understand the horizon over which they will pan out. Take, for example, climate is one of those known unknown. We still don't know how the implication of it, but we know it exists and we have to prepare for it. Cyber risk is another one. There's so many other risks out there. So the capabilities to deal with those, I suppose, non-traditional, non-financial risks, in my opinion, the best approach for that is scenario-based approach. You have to be able to construct I suppose a scenario where you bring in all the senior experts in one room and then rehearse as if the event has happened. And then you walk through the various processes and the steps you would do as an organization to deal with those events.
You talked there about bringing the senior experts into the room. Presumably that team has to look quite diverse as well, totally, to allow that sort of expert view to come across.
Absolutely. Like there will be like as one group, one team, but they will have diverse disciplines. You will have the legal, you will have the finance, the risk, the business, the compliance. And then all of them rehearsing one single scenario. That scenario could be, for example, let's say an IT cybersecurity scenario where you have a breach or malware that has access to your customer data. You put it out there, and then the output of that exercise is a good understanding, of course, of what the implication of that event is going to be on everything, business process, people, technology, but also financially speaking, how much costs or losses we're going to suffer out of this. And the cost of that could be direct or could be indirect. So things like you might face very straightforward fine or a penalty from your regulator, but also could be loss of business, reputational damage. And you have to walk through all of these. And those banks who've done this very well, they can link this then into a potential capital buffer that you put as part of your capital requirements in terms of Pillar 2 or ICAP processes. But also, I see this type of exercise extremely useful for your external stakeholders in terms of either investors community or regulatory community trying to look at you from the outside in approach. Have you thought about those risks? Yes. What's the implication to your business? And then you have a heat map and they can engage in conversation around those.
You've given us a lot to digest there about what we need to be doing better. Do you think in this sort of environment that is quite fast moving and very challenging, the CRO's role has had to evolve and change during that period?
Yeah, absolutely. And the CRO role is like, it's pretty much multidisciplinary type role. It has to deal with so many different aspects. In a way, it's a strategic partnership role for the CEO and the board in terms of guiding strategy in a risk sort of sensitive way. But at the same time, it has to be somebody who is very good implementer in terms of making the change, so change manager, people manager, influencer, and at the same time being able to face off so many different stakeholders in terms of different the last thing we inherited or very pleased with is the global climate change risk agenda. So somebody said, well, that should be a CRO piece, so off you go. So this is the sort of things you have to deal with, ranging from very simple plain vanilla, I need to give a loan to a customer, what's the likelihood that loan being repaid, to what do you think the climate change is going to do to your portfolio. And they're very diverse skill sets.
And is it nice to have an event like this to be able to share thoughts with other CROs in that similar demanding position?
This is the single one most important event I always attend because it's so diverse and it brings focus to the risk agenda in a very nice, diverse way. So you have all the various players there. You have the practitioners, you have the academics, you have the consultants, you have the auditors. And we all come and talk about risk from various angles, which is very helpful.
It's great to have you here. Thank you so much for joining us. Good to have you.
Thank you for your time.